Welcome to Dr. Fred Markets. This is not financial advice. Most people will never understand how crypto, AI, and global finance are reshaping the world. The rules are changing, and the ones who adapt early come out ahead. You're here. You're paying attention. That already makes a difference. Let's go.
Nuclear reactors are about to become Bitcoin's landlord. Verdict: the first country that weaponizes nuclear energy for crypto mining wins the next financial decade. Full stop. Signal 1. Look at pure boring physics. 1 kilogram of uranium-235 releases about 24 million kilowatt-hours of energy when fissioned. 1 kilogram of coal, roughly 8 kilowatt-hours. That's a 3 million to 1 energy density gap. Translate that into mining. If your competitor burns gas at 5 to 10 cents per kilowatt-hour, and you're feeding miners nuclear power at 1 to 2 cents all in, their margins are your future forced seller discount. Energy cost is the only boss in Bitcoin mining. Hash rate votes. Electricity decides who stays solvent. Signal 2. Follow where the miners are fleeing. In 2020, China hosted about 65 to 70% of global Bitcoin hash rate. Then Beijing nuked the industry. Hash rate cratered, then relocated. Now, the US sits around 35 to 40% of global hash rate, with Kazakhstan, Russia, Canada, and a rising mix of Middle East players behind it. But here's the part you never hear on CNBC. The marginal hash isn't chasing free hydro anymore. It's hunting stranded or overbuilt baseload, exactly what nuclear creates when regulators overestimate demand. Nuclear plants don't like ramping up and down. They spit out constant power like a psychopath with a schedule. Crypto miners are the only customers deranged enough to show up and say, "Yeah, we'll buy every spare watt, 24/7, no complaints." Signal 3. Governments are already stress testing this marriage in plain sight. Texas. Bitcoin miners made over $30 million last year just by turning machines off when the grid screamed for help, getting paid more to not mine than to hash blocks. That's energy demand response on steroids. Now scale that to nuclear. France gets about 65 to 70% of its electricity from nuclear. The US still gets nearly 20% from reactors that are old, expensive, and politically awkward, but physically elite at cranking out steady power. Slide in miners next to those reactors, and suddenly unprofitable nukes become cash-gushing hardware banks that print Bitcoin during off-peak hours and stabilize the grid on command. So when you see live headlines screaming about Iran, war risk, and oil supply fear, ask yourself one thing: who benefits most if oil stays chaotic and nuclear becomes the boring backbone? Here's the connection nobody on TV wants to spell out. Crypto mining is not just consumption, it's an off-switchable demand sponge for rigid power sources. Nuclear is the most rigid, highest-density power source humans routinely operate. Put them together, and you get a new kind of financial instrument, a nuclear-backed, programmable energy sink that mints digital collateral on demand. Oil is political, gas is volatile, solar and wind are flaky toddlers. Nuclear is the grumpy old landlord that never moves, never sleeps, and never negotiates.
Does what you just heard shift something for you? That feeling, that need to know more, is exactly the right reaction. Most people never get there. You just did. Let's keep going.
Miners plug into that landlord, sign a long-term take-or-pay in silicon, and suddenly nuclear plants stop begging regulators for subsidies and start earning in the hardest money the internet has ever seen. This is not ESG theater. This is raw, cold incentives. When you pay off a reactor's fixed costs faster via mining, you de-risk the plant. De-risk the plant, and financing new reactors stops looking like political suicide and starts looking like infrastructure alpha. You don't get a green Bitcoin. You get nuclear collateralized hash power that makes oil-linked miners look like blockbuster video. Here's what this means for you, sitting there scrolling headlines about war and stocks. First, stop thinking Bitcoin is just number go up. The real game is who owns the cheapest, most reliable electrons for the next 30 years. Nuclear wins that math, even if it loses every Twitter argument. Second, crypto mining is becoming the financial layer glued directly onto the physical grid. The miners that survive will be the ones married to long-duration, low marginal cost power, and nothing fits that description better than a reactor with its capex already sunk and a government desperate to keep it running. Third, nation-states are not dumb forever. The minute a finance minister realizes If we pair nuclear to mining, we convert stranded baseload into liquid reserves. The policy conversation changes from ban Bitcoin to nationalize the hash rate. Action time. One thing you can actually do today. This is not financial advice, but here is the truth. If you stay stuck arguing about crypto prices and ignore who owns the nuclear-grade power behind the hash, you are betting on the wrong end of the trade. So your 3-point checklist. 1. When you research any mining-adjacent investment, ignore the hype and hunt for one metric: long-term power contracts with nuclear or nuclear-proximate baseload. If the energy input is unstable, the business is cosplay. 2. Watch policy, not just price. Track which jurisdictions are extending nuclear plant lifetimes or quietly pushing modular reactors. Those are your future hash rate fortresses, even if they ban mining publicly today. Bans are negotiable. Energy math is not. 3. Rewire your mental model. Crypto mining is just finance wrapped around a power plant. If the power plant is nuclear, that's a 30 to 60-year option on cheap energy. If it's gas or oil, you're renting volatility. Don't rent volatility if you can own stability. The market will keep screaming about Trump, Iran, and Netflix drama. The real story is simple. Whoever chains nuclear reactors to crypto miners first doesn't just win the hash rate war. They rewrite the balance sheet of their entire energy system. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.